Joining us live on the show is Nick Paulson, Country Head Strategy and Special Situations at Espirito Santo Securities. Nick joins us live here in our studio. Afternoon, Nick. Thanks for joining us. First up, what do you make of the market mood right now? Do you think, given the fact that there's likely to be any positive surprise over the next couple of weeks, the bias is likely to be downwards?
I think it is at the moment. I think there was a lot of expectation built into the UP elections and the budget, and since then I think there's been general, it's weak market since then, disappointment, and I think there's then also globally, because a lot of the rally this year has depended upon liquidity, and there's been a little bit more nervousness in Europe in the last week or so, a little bit more nervousness about China, some of the Chinese economic data. So in the absence of the kind of risk-on trade, fundamentals in India look more challenging. You've got coal scandal, you've then got TCI raising governance issues at Coal India. I think all of this is negative, along with this retrospective tax issues. So I think sentiment at the moment is fragile, and domestic investors have been net sellers this year, so a lot depends on foreign investment.
Nick, I was just coming to that. I mean, how spooked are institutional dealers with regards to JAR and now them having to change their taxation clauses?
I think they're spooked, and they're doing a lot of work on it. I know a lot of foreign investors are trying to get their heads around exactly what does this mean. If you're Vodafone, you're still unsure, but also foreign investors, FIIs, they're all taking advice at the moment from tax experts. And it's that sense of retrospective judgments, and I think it raises a specific tax question, but then raises a wider issue of generally, as a climate, how friendly is India to foreign investors.
Also, the rupee movement that's come in is a bit of a surprise. We are back to levels of 51.50 or so. How do you see that impacting the position of foreign investors?
Yeah, so I think, because our call had been the rupee moving back to 48, and it's weakened over the last few weeks. I think, because when I was in the US at the end of the year, a lot of the negativity was actually partly around the rupee, and I think it's just another negative for foreign investors, and I think that it's a key one to watching over the next few weeks.
Nick, Coal India is a company that you track quite closely, and you just reiterated to the issue with TCI. Where do you see it settling really? And in light of all the developments and the murkiness surrounding the company right now TCI demanding a management change as well, would you re-rate the stock?
I think we don't cover Coal India from a fundamental coverage perspective, so I can comment on what we see in terms of the governance situation rather than the fundamentals of Coal India. I think we used it as an excuse really to look at the overall. We do a lot of work on corporate governance, and as part of our approach, all the companies we cover, we have a governance framework on. And I think ultimately the fundamental problem for minority investors in India is most stocks have a majority shareholder who's a promoter or dominant shareholder, be that the government or somebody else or a family group. I think it's 463 companies out of 500 in the BSE 500 have a promoter. That's unlike any other market really in the world. And I think TCI is raising a major issue, but it's a very politically difficult one, because whether they're right or wrong, it's very difficult for the government to start pushing through price increases because of the state that the power sector's in and the state that the SEBs are in. So it's politically impossible, but it's very embarrassing to the government in the face of a very large divestment program over the next 12 months. The last thing they need is a very public spat on a major PSU and making people ask questions around governance, especially it's in the coal sector. There's now a lot of news on coal and misappropriation of assets or mismanagement of assets.
Let's talk about some of the sectors and stocks that your brokerage does cover actively. ITC, for instance, is a high conviction sell on your list. Why is that?
Well, yeah, it's a high conviction sell which hasn't worked yet. I think our sell on that was really a function of, one, price, and two, we think that the ITC strategy, it was a sell going into the budget, and we thought price increase that it would be forced to push through to drive volume, and would be those price increases were going to affect volume, and both in terms of tax changes and the changes in terms of policy, so cigarette length, and we still stand by that. It's yet to play out. You're seeing both state level tax changes just beginning to come through. But ultimately, if the market gets more defensive, people like the fundamental strength of ITC, and we have not seen the weakness so far. So a combination of really valuation and changes in terms of taxation, and we're predicting relatively weak volume growth from ITC. And you've begun to see a little bit of change on the street in terms of sentiment towards it from other brokers, where I think it was 47 buy recommendations when we came out the first sell. You've seen some people coming out with neutral weight or underweight, which is, I think, the beginnings post-budget of sentiment changing, but not yet in terms of any meaningful sellers.
You have a view on Max India, and a buy one at that. considering the stock is holding up today as well, what is it that makes you so bullish on this one?
Well, I think if you look at India at the moment, it's quite difficult to have a very high conviction macro call about the overall economy because of the policy environment, the constraints on the RBI. So our approach is more find interesting particular sectors where you're not likely to see major regulatory change. They don't depend too much on government policy. But yet you've got the kind of classic traits of under-penetration. I think you look in the insurance sector, you've got the benefit in terms of demographics, people going to a savings phase, accumulation phase of their life. You've got very, very low level of penetration, valuations that are attractive relative to other emerging markets like China, and frankly in an underappreciated sector. There aren't very large listed insurance companies, they're mostly subsidiaries. There aren't very many insurance analysts in India. It's not well understood. Max India is a good listed example. We like the business. We like its underwriting, and we've been, we like it thematically, and we like it specifically as a stock as well.
Going forward, would you start looking at defensives, or do you think you'd still bet on high beta stocks?
Well, you might look at defensives if they weren't so expensive. It's still, you look at Nestle, great stock, but do you want to pay 37 times for it? You're hiding if you're buying that, and it's always been expensive. But I think FMCG remains very, very expensive. I think maybe healthcare, where different drivers, less exposed to the kind of challenges we're talking about. I mean, so it's defensive and not as expensive, but I think it's still, risk on is still a theme. I just don't think it's not as strong and obvious as it was at the beginning of the year. And I still think some pockets of power and infrastructure, if incremental progress is made during the year, because the valuations have been down, like ports, for example, there's still potential in those sort of businesses. So I don't think it's a straight reversal to defensives.
What about crude, and what is your view? If we were to see an appreciation of, say, $10 to a barrel from here, what would it mean for economies like ours? And therefore, would it end up, having a market decline of 10 to 15% from the current levels?
I think with crude, you look at the two factors. One is the issue of it's a risk asset as well. So partly it moves with the market in India. There's then a lagged effect in terms of the negatives that everybody knows around fiscal deficit, current account deficit, and inflation, and what is the pass-through, the full pass-through. It's meaningful. I mean, everybody knows the stats of India imports 80% of its oil, so it's certainly a major headwind at the moment for the market, and it's a headwind on three fronts. It's damaging in an already challenging fiscal situation. Fiscal consolidation is not trivial. The data looks okay in terms of if the government achieves its target, great, but it's whether people actually believe that, and a strong oil price makes one question the viability of the fiscal target this year, and it just makes the RBI's life more difficult in terms of inflation. We don't think the RBI has much room to manoeuvre anyway in terms of rate cuts. We reckon it'll be a sort of 125 basis point max in the whole of FY13, and starting slowly and being a gradual cycle, and oil's not helpful.
So will we see anything at all in April?
We think we will, but it's looking more and more marginal.
And for banking stocks then, it'll be just a play on rate cuts going forward?
I think it's more discriminating. I think on the PSUs, the valuation discount has closed a little bit. Of the PSUs, we still like SBI and Bank of Baroda, which got left behind. And then on the private sector banks, actually, we prefer some of the smaller ones like Federal Bank. So it's more a discriminating view rather than a major call on buying banks into the rate cycle. I think a lot of the rate cycle has been priced in because it's been so talked up in the first 3 months of the year.
All right, Nick Paulson, always a pleasure having you with us in the studio talking about markets and sectors. Great having you on the show.
Thank you.